What's going on, everybody? Time for another market update video. Last week's got pretty long. Trying to keep this one a little shorter, but as I was going through my research for the week, I kept finding more and more things I wanted to talk about, so it could be kind of long. The song theme of the week, I can't play the song apparently because YouTube sucks, but I will show you the song. I don't know if this is a real well-known song, but a very good song, and kind of fits this week because I think the bulls are trying to keep the bears away. There's a decent amount of headwinds for bulls for the next roughly 8 trading days until we get to April, and I will get into that later in the video. Thought of the week is to set realistic goals for yourself. And the reason I say this is because I often have not set realistic goals for myself. And then if you're always setting goals that are unrealistic and you never achieve them, you're just always setting yourself up for disappointment, right? So that's the idea there. There's the song. Okay, we're going to roll for next week's push-ups. Last week I had, well, I'll show you at the end. I think I have 176 push-ups to do. So I'm going to lower the count just a little bit this week as the subscribers start to grow a little bit faster. I assume 20 push-ups. If I would get unlucky and get 20 push-ups, that could be quite a bit. So we're going to do 2 rolls. The first roll is a 1 and a 2. 1, regular push-ups. 2, clapping push-ups. Okay, so we got a 1. So we're doing regular push-ups. Now this is the number of push-ups per new subscriber. 5. We got the max. We did 1 and 5, we got 5. So we're going to do 5 push-ups per new subscriber. No pain, no gain. This week's blog post was about the DIX-GEX sell signal, which came from this guy, Next Signals, who used to be on Twitter, which is a very cool account. He always posted really interesting stuff, but he no longer exists on Twitter, unfortunately. But this is a cool little signal that he came up with, and the blog post that I did basically is trying to improve upon that. I'm not going to go over it in this video in order to try to keep the video a little shorter this week, but read through this. I think I did a good job in coming up with a better methodology for that. Also, here in this blog post, I have my weekly schedule for the videos coming up. Try to keep to that, but no guarantees. Bonds have been in focus recently. Didn't talk about them last week, so I thought I'd talk about them a little bit this week. Quite a sell-off in bonds. And my view of this is that I think a lot of bond speculators just had the idea that the Fed was never going to let bond prices fall and yields go up again, that they were going to keep yields just at 0 forever, and there was going to be endless amounts of support. And I think you finally saw that break down when the speculators realized that, hey, they're not going to keep rates that low forever. And I know the FFR has not changed, but they set these bond rates. It's not just FFR that sets your bond rates. It's bond purchases and bond issuances, and it's very complex. But needless to say, the bond market, I think, was a little misguided in thinking that these prices would hold up forever. So every dip, I think speculators were sitting here looking to aggressively buy and take those yields back close to 0, close to that FFR rate. And there just wasn't that much support there. And so you had an over-positioning situation, and bonds tanked. And who knows how long it's going to continue. That this was a long time that bonds held near the highs. So there's probably a lot of excess positioning that maybe still needs to wear off. That being said, I decided to look at the rate of change on ZB, which is the 30-year Treasury bond. and it is sold off pretty aggressively. Rate of change is a very simple indicator. It's really just percentages. It's just the percentage in the last, in this case, 50 days that it's dropped. That's really all it is. It's not complex, and that I like simplicity when it comes to price-based indicators. I don't like a lot of these more complex ones that people seem to like. Anyways, I decided to back test this, and you can see this minus 9.2 rate of change on the 50-day. It's pretty extreme, right? If you just put a line on it, we haven't seen it too many times. So I thought I'd look at a back test of that. And as you can imagine, bonds did pretty well after you have that big of a sell-off in 50 days. Even did better than the S&P 500 going out up to 6 months later. So is the bond sell-off overdone? I think so to some extent, but we will see. Certainly trends nowadays seem to last longer than they used to. So, and certainly there probably was a lot of excess positioning, and who knows how long that's going to take to wear off. But I think bonds are probably getting there, which hopefully will stabilize. Longer duration assets, which is your growth and your tech, and obviously bonds as well. The longer term bonds. Some improvements in a lot of metrics that I like, particularly the DIX on Friday, 47% was excellent. Really like to see that. That's one of the things I've been wanting to see, and we finally did see a really, really strong dark pool print. So that's good to see. This brings up our 5-day moving average to 69th percentile for the whole data set. So certainly above average and better than last week. And here's your back test for when we see that. Roughly that we're in that range here. Pretty solid forward returns when we see that. So that is a nice improvement for the bulls. Nice to see that. Semiconductors, dark pool index, still light overall compared to history, but it's improving. Good to see. Tech ETF, same. It's improving. FANG, dark pools, pretty good improvement this week. Long-term breadth, there's a million ways to dissect this, but all this chart is percentage of stocks above the 200-day average. Currently at 86%. Long-term breadth is still very healthy here. It's definitely one of the things that's remained bullish despite the pullback we've had in the last couple months. Hedge fund exposure is just above neutral. I'd like to see it lower, but it's still relatively healthy here, I would say. COT positioning, commitment of traders report positioning, and pretty good improvement this week. This is pretty healthy still. This is a very supportive metric for the bull case still. This is something I found interesting. This is OTC volumes. This is just an example of kind of the retail exuberance we've been seeing. It's still way above where it was historically, but it has cooled off significantly. Is it enough of a cool off? Probably not yet, but eventually I think we will get a bigger cool off. It's probably enough of a cool off to take us to new highs, but we got some work to do next week and into the end of the month to get through this end of month selling, which I'll talk about soon. This is an interesting metric. I have never looked at this before, but it's just something that I saw recently I thought I'd share. The put call ratios, I noticed the perma bear crowd hasn't talked about this as much recently because, well, it didn't work for months and months and months and months. And the reason it didn't work, because it was the only metric that was really extreme bullish for many of these months back here. So people like to focus. The perma bears always focus on the things that are bearish, obviously, but there was a lot of reasons to be optimistic in this area when put call ratios first started getting extreme. Dark pools, COT, other things. They weren't talking about that because it wasn't bearish, but they're not talking about it as much anymore. And I've noticed that it has been pretty accurate actually recently. When you get these extremely low daily prints. It's been a warning signal several times recently. So it's something I think worth keeping an eye on. I think in terms of options, there are better ways to track the options market, which I've shown and I'll show some more of. But that doesn't mean that the put call ratio is completely worthless either. I think when anytime you see an outlier type of number on a metric, even one that's kind of inferior like the put call ratio, I think it's something you should factor in. Or you should think about at least. And these are definitely outlier numbers here. So I tested it. So this is when the 1 year rolling percentile is less than 5th percentile. And probably should have done 1st percentile because these are all like 1st percentile, like extremely low. However, for the entire history, it's really not that bearish. Yeah, it's below average going out to 3 months, but positive average returns in that time frame. It's not the most bearish metric out there. Part of the reason I'm not the biggest fan of put call ratios, but when combined with some other factors, and we have had some other factors kick in recently, it's a factor. And recently, so I just did since the start of 2020. Recently, it's been a bigger factor. And yes, I'm including the March 2020 crash, so it probably skews this quite a bit. But 5th percentile put call ratio prints has been quite bearish up to 3 months out since January of 2020. So it's something worth considering. Not the most important thing in the world, but it's definitely something worth considering. So now getting into the idea of there's potential headwinds coming up at the end of the month. There's the pensions and the 60/40 funds that have to rebalance at the end of the month, and even at the end of the quarter, it's a bigger rebalance usually. And so we're coming up on end of the month and end of quarter. And you've seen equities rally a bit while bonds have been tanking. So the 60/40 funds, for people that don't know what that is, those are funds that are 60% equities, 40% bonds, and it's kind of an all-weather type of portfolio that is supposed to smooth out your equity curve, because when stocks dump, bonds are supposed to rally. Hasn't exactly worked that way in the last year or so, but anyways, they have to maintain that 60/40 balance. So when bonds tank, they have to sell their equities and buy bonds to get back to that 60/40 ratio. Pause the video and read through this if you want. I'm not going to read through the entire thing, but just know that there is a lot of selling potential out there until the end of the month. If the SP can hold up till the end of the month, and I'll talk about that, I think bulls will be fine, but we'll see. This is somebody in my Discord posted this, and this is very interesting. It's talking about the recent options expirations, and I've talked about this as well. We've seen, since we have a lot of net call buying in the retail space, we've seen very commonly on the options expiration week, which is every third week of the month, some selling, at least sideways if not down, has been extremely common. You can see since October, down October, down November, down December, down January, down February, and down this month as well. And my theory, and I think it's a valid theory, is that the high call buying causes you to see theta decay all week on expiration week is much stronger. So if you don't know what theta is, look that up. But theta is just time on options, and theta kicks into overdrive on option expiration week. And so the dealers are net short those calls because the retail speculators are buying them. The dealers are short those calls. The dealers are always neutral, so they're hedging that exposure by being long stock or long futures. So they're, as the theta is reducing the value of those call options during the week of expiration, like aggressively the theta is ticking away on them. The options dealers are selling stocks, selling futures. That's why we keep seeing this, and we'll probably, in my opinion, we're likely to keep seeing this as a phenomenon as long as the put-call ratios are doing what they've been doing. I really think that's going to continue. I don't see an end to that anytime soon. And then end of the month selling, that's going to continue as long as bonds are tanking, which I think is close to being over, but we shall see on that. I don't think the end of month selling will always be a thing as long as the bonds stop their bear market they're currently in. VIX expiration actually is kind of mixed. We've actually been up a decent amount of times, but all these others end of the month, the last 2 weeks, so your third week is your options expiration, your fourth week is your end of month rebalancing. The last 2 weeks of every month, there's headwinds, some significant headwinds for stocks the last several months, and will continue if bonds continue what they're doing. And I don't think the call buying's stopping anytime soon with this new stimulus and just the way the trend has been. It's been very persistent. The fund manager survey came out. Couple things to note. This reflation rotation trade that everybody's talking about. It does appear the fund managers are all in on that now with very high commodity exposure compared to history. And interestingly, tech is now, they're way underexposed compared to history, and they have very little cash positioning, which is also scary, and equities, overall equities exposure is pretty high. Overall, maybe this means we get a rebound in tech and the commodities plays continue to pull back. And we already saw oil the last few days take a huge hit. So perhaps this overpositioning needs to adjust a bit. Index put call ratio again. Big spike, largely because of OPEX. You get these weird spikes on OPEX, but still there's a lot of index open interest in terms of puts, which stabilizes the market and prevents major crashes. Like before February, notice they were not holding near as many puts. Part of the reason we crashed. So we're still pretty stable on that metric. Last week I talked about the VIX and the fact that it won't go under 20, and we had several closes under 20 this week, so that's a good sign. And the reason that it's a factor is because there's a lot of quantitative methods that rely on VIX under 20 to get long, and it's these down here. And I should do a different color with that and not be stupid. There we go. There you go. So my theory continues to be we get VIX under 20, we get maybe even down to 15. I don't think we're getting down to 2017 levels anytime soon. But we get VIX down a bit more. We get these guys long, get these guys somewhere up in here. And these are probably going to just get worse when that happens. And then we'll have basically everybody on one side of the boat. Then you'll be set up for a real correction that kind of clears some of that retail euphoria I've been talking about. I still think that would clear up the picture and make the probabilities much more easier to understand and just clear in general. So talking about the end of month selling and the headwinds that we face, I did notice this week that we had the classic stop run under 3,900, right, on S&P 500 on Friday. Or, yeah, that was Friday. This is a 4-hour chart. Came right down to the 20-day moving average, like to the tick, and reversed. But I'm going to show you an order flow on ES. I wasn't real happy with the amount of responsive buying that we saw coming up. A lot of times when you have a stop run, you'll see really aggressive buyers come in, and then from there we just rally for days on end. I didn't see that on Friday. I'll show that to you. So I think this 50-day moving average could come into play. I've seen a lot of people say we're going to test the 50. And I don't always necessarily disagree with people when a lot of people are saying it. A lot of people would say, too many people are saying that, we can't go down there. I think I see enough evidence with end-of-month selling, with the lack of aggressive responsive buying. I think we could go to that 50, but it's not very low. It's not very far down. It's 38.61 right now, and it's going to keep rising, obviously. We will meet it. I think there's a good chance we'll test that 50-day. Before the end of the month and before we potentially rally again. So the response when we get to that point will be important. So here's my probabilities. Yeah, you can read through this. I think there's a pretty good chance we're going to hold this, and I've raised my probabilities because of what happened with DIX this week, and COT continues to improve. I continue to see more reasons to be bullish than bearish. Breadth is still strong. There's still a lot of reasons to be bullish. But it is still pretty mixed, with retail still way too extreme. You still have crazy stuff going on with this NFT thing and with SPACs and just some real euphoria in certain sectors that eventually I think gets reset. It may not be till May, like I said, when seasonality finally shifts, that we see that. And we'll get everybody long on one side of the boat. Then the probability, you could see me go 65 to 70% of downside, which is extremely rare for me to go that aggressive with downside. But if we get that set up, I will probably do that. I was going to show you guys order flow. Which one is it? Too many charts. Okay, so here's Friday. This is a 5-minute chart of ES, S&P 500 futures. And here's the stop run. It was on ES, it went down to 38.75. I think there's about 15 points of contango between SPX and June contract right now. So the prices are lower. You have this rundown, which with fairly aggressive selling, and then you have the run back up, and I just didn't see enough aggressive buying that I'd like to see. And so this is in the cumulative delta. You saw it was pretty aggressive selling right here, and then the buyers just were not that aggressive on the way back up. Not like I like to see. I'd like to see a big washout. You know, you went under here, got all these stops. It's a stop run, right? Came back up. And even in terms of price action, it'd just be nice to, you'd like to see just a rip with no pullbacks, just a straight V bottom when you have a stop run like that. And we didn't see that either. Not enough positive delta. A lot of things I didn't like about the reversal. That doesn't mean we can't hold the lows here, or that doesn't mean we don't gap up and go on Monday. It's just didn't quite see what I'd like to see out of the order flow on Friday, and especially when you start getting into large lots. So 6+ contracts and 50+ contracts here. Just like they were just still selling after the lows came in. Not what I typically like to see. Doesn't necessarily mean anything has to happen, but it just talks about probabilities. So looking at the 60-minute chart, yeah, you saw aggressive selling and just no response from the buyers. Here's the cumulative delta on the 60-minute chart. Pretty aggressive selling. You'd like to see that response, and we didn't see that. So let's go back. I think we're almost done with this video. Not too bad. Oh, I was going to talk about the music from last week as well. I noticed some of you guys said that Led Zeppelin is also your best band. Probably you're just kissing my ass, but that's fine. I'm okay with that. But for those of you that said Led Zeppelin is not the best band, there's a couple options for you. You can get your hearing checked. That's the first thing I would recommend. Second, they got these things called earwax removal kits. Works pretty good. You may just have too much wax buildup, and that's affecting your hearing. I mean, your eardrums are probably fine, but you got to clear that wax out so you can hear the beautiful Led Zeppelin sound. Third option, and it's a little bit extreme, but electrical shock therapy, I've been told, helps with people that have these weird brain elements where they can't understand what good music is. So try those things. Oh, and I forgot to tell you, you're supposed to listen to the song of the week in another tab with the volume turned up at 11. Do you guys need me to show you how to do that? So to listen to this at 11, turn it all the way to the right, and then you press Alt F4 on your keyboard, and you're good. You'll be at 11. Brent, you guys try it? Try it and let me know how it goes. Just curious how that goes for you. Okay. Now I'm going to go do the push-ups, take a video of that, and upload that to the end of this video. It's 176, I believe. Let's see. Are we still at 66 here? 66 subscribers, so 16 times 11, 176. And also this week, I decided to do a beer of the week. I love beer, and you know, it's weird because I work out quite a bit, but then I drink probably way too much and offset all of it. But anyways, I really like this beer, Alaskan Brewing Company Amber Ale. I like ambers and reds. A lot of people like IPAs. They're just so strong and just overpowering with the hops. I do like them, but not as much as I like ambers. So I'm going to go do my push-ups and then probably do a recovery drink of some Alaskan Brewing Company Amber Ale afterwards. I had some last night. Pretty cool can. You got to like the can. And it's extremely tasty beer. So go have you some of that. Let me know how many of those you guys have. Hopefully you have as many of those as I'm about to do push-ups. And I think that's it for this week's video. Hopefully this one wasn't too long. Let's see how long this one is. I'm a little bit long-winded sometimes. I tried to keep it shorter this week. But we'll see. We'll see. Hopefully it was a good video for you guys. Let me know if there's anything else you want to hear about. Anything I could do to improve. Anything along those lines. Just let me know. Like hearing from you guys. Talk to you later.